Hola, welcome to Basics Simplified. Today we'll be looking at money market instruments. We'll see what they are, the kind of money market instruments and how they behave and try to understand them as simple as possible. Okay, let's get started. First of all, what are money market instruments? They are short-term, easily liquefiable securities which commercial banks, scheduled banks, companies or even the RBI uses to raise up money which they need urgently, while the person investing the money in can either wait up until the maturity, which is usually less than a year, or they can trade it and get some easy money. Okay, so they're easily liquidable and they have very low risk. Okay, so let's get started. When you hear the word money market instruments, two things should come to your mind. First of all, they are short term. So when I say short term, it means up to 1 year maximum. Okay. Now let's see. So there are 5 money market instruments. Okay. So the first one is treasury bill by the RBI, commercial paper, just like the name specifies, it's by a corporation or something. Call money, it is between banks. Certificate of deposit, this is also by a bank. And commercial bill, this is by companies or buyer and seller in trading. Okay. So let's start off with treasury bill. If you know what a bond means, treasury bill is pretty easy to understand. If you don't, this is how a bond behaves. So when you get a bond, savings bond or whatever bond, it has something called a face value. Say if a bond has 1,000 rupees face value. Okay. So, and it will have a maturity of 1 year. So you will be buying the bond at something called a discount rate. So you are buying 1,000 rupees bond at 900 rupees. Okay. The person offering the bond will give it a rate of interest. So every month or every quarter or every half year, you get an interest for holding this bond. At the end of 1 year, you can redeem this bond and get the 1,000 rupees back. So you initially spend 900, you are getting 1,000 back, which is already 100 rupees profit plus interest. This is how a normal bond behaves. Okay. The RBI, when they need urgent money, they raise something called as a treasury bill. Okay. It is also called as zero coupon bond. Pardon my writing, but it's also called a zero coupon bond. Okay, so what does zero coupon bond means? Basically means that there won't be interest. It behaves just like a bond. It has all the features of a bond except the interest part. Okay, so what does RBI do? They would release a bond. Okay, a zero coupon bond or a treasury bill which would have a face value of 1,000 rupees and you can buy it at a discounted price of 900. So the RBI needs urgent money. They are getting 900 in urgent money. Right? You are buying 1,000 rupees bond at 900 discounted value. At the end of 1 year, you can redeem this bond and get 1,000 rupees back. So you make 100 rupees in profit, RBI gets urgent money. Both of you are winners. Clear? Unlike traditional bonds, you don't earn the extra interest part of profit. That's the only difference. Okay. Next one is commercial paper. Commercial paper is just the same thing as this, except it is offered by a company or corporation. Okay, commercial bill is the same thing as treasury bill. Sorry, commercial paper is the same thing as a treasury bill, except it is offered by a company. Okay, so what does this mean? Let's see. First of all, it has the same concept. So if say company ABC wants some urgent money, what they do? They release a 1,000 rupee face value bond with 1 year maturity and you can buy it at a discounted value of 900. At the end of the 1 year, what happens? You can redeem the bond for the full value. Clear? That's it. Whatever you learned here comes here. Only difference, RBI does this. Here you have a company doing it. Clear? Okay. What about call money? Call money is basically bank to bank borrowing and lending. So if a bank needs urgent money, they have repo rate, reverse repo rate, they have MCLR, MSF and all those things. Okay. But it's not like they always agree with that interest rate. It's not like it's always profitable to them with that interest rate. So if say bank A wants 6 crore rupees, okay, bank A wants 6 crores. So what does bank A do? It just calls bank B. I mean actual call, not call me. I mean actual call. It calls a bank B and says, I need 6 crore rupees. Send it to me. So bank B would send 6 crore rupees to bank A. Okay. The thing that you have to remember is that this happens so regularly. They have something called a call rate. So call rate is basically an interest rate for this. So bank B and bank A would have an interest rate understanding. They would say that if I or you borrow money from each other, we would pay each other say 5% of interest, whereas borrowing from RBI would be like 7% of interest or something. Okay, so this interest rate would be cheaper than the other ones. This and banks would be like you can get instant money, you're paying lesser interest. So what's the harm? Okay, the major difference is under call money. If bank A is borrowing 6 crore from bank B can call back the very next day, demand the money back. There is no 1 year time, 2 year time, there's no maturity period. It is instantly redeemable. Okay, remember the word liquefiable. So it's instantly redeemable. They can call up any time, get the money. So basically, interbank borrowing and lending with a fixed rate that they fix between each other. Okay. Now that you know all three, let's go to the other two. Certificate of deposit. It sounds so complex, yet you can understand in one word. It's the little brother of a fixed deposit. Excuse me. It's the little brother of a fixed deposit. How does fixed deposit behave? You do a one-time input of money, right? You're putting in 10 lakhs, let's say. Okay. And it would have, let's say, 7 years of maturity. At the end of 7 years, you get the 10 lakh and the interest. Clear? In certificate deposit, there are two differences to it. You have same one-time input of money, and you do this one-time input of money either minimum of 1 lakh or multiples of 1 lakh. So it's 1 lakh, 2 lakh, 3 lakh, etc. Okay. The second difference is, what are we discussing about? Money market instruments. What's the most important point in it? Less than 1 year. So it can be maximum 1 year. Okay. So for certificate deposit, this 7 years becomes 1 year. That's it. You do a one-time investment. You have 1 year of maturity time maximum. You get a rate of interest for doing that deposit, and you can withdraw at the end of 1 year. Done. Just like a fixed deposit, except a puttier version, a shorter version. Okay. And the last one, commercial bill. So commercial bill has another name called trade bill. Just from the name, you could understand what it is. When trading happens, some people use this. Okay. So let's see how it happens. So we have a buyer, we'll call him B, and we have a seller, we call him S. So buyer is selling, let's say, eggs. Sorry. I'm sorry. The seller is selling eggs, and the buyer buys the eggs. Okay. So in a wholesale trading, what usually happens is that you have the buyer who buys the stuff at credit, right? He would say, give me all this, I'll pay you at the start of every month or at the end of every month. So there is this whole time lag for the seller where he'll either get the money either at the start of the month or at the end of the month. He doesn't have any immediate money sources. Okay. So the seller, say, wants to get his daughter married or some family situation, he needs some money. What he does is, he will go and raise a commercial bill, okay, with a bank, and he will say that I am raising this commercial bill for, say, this transaction is 1 lakh worth. Okay, I am raising this commercial bill for 1 lakh rupees, and he gives this commercial bill to the buyer. If the buyer accepts, okay, the bank will take up the responsibility and the bank will pay the seller instead of 1 lakh, just like your zero coupon bond. Instead of 1 lakh, the seller gets 90,000. Okay, so there is a commercial bill worth 1 lakh rupees, 1 year maturity. What does it do? You remember anything which is similar to this? Right, the same way. So the seller writes a commercial bill with the bank and for a value of 1 lakh rupees with 1 year maturity. Okay, so the bank would pay the seller 90,000. Okay, and say like, okay, I take up the responsibility instead of the buyer. I'll give you 90,000 for the 1 lakh worth of commercial bill. The seller is happy, he's getting immediate money, and the bank goes to the buyer and says, I have paid the seller. Within 1 year, you have to pay me back 1 lakh. Okay, and that's what happens. The buyer, you usually pays him back at the end of the month or the start of the month, right? Just for him, it's the same thing. At the end of the month or the start of the month, he pays back the 1 lakh to the bank. Bank makes 10,000 in profit. Seller gets immediate money. Buyer doesn't have to pay immediately. Everyone's a winner. I'll do it once more just so that you don't get confused. Okay. So a person buying eggs from a seller would reimburse the seller either at the start of the month or at the end of the month. Okay. There is no direct transaction whenever he is buying. There's only month start or month end transactions. Now the seller has some family emergency. He needs some money. Okay. The buyer has bought 1 lakh worth of eggs from the seller. 1 lakh rupees worth. What the seller does is, he goes to a bank, he raises a commercial bill saying, you reimburse me for this 1 lakh bill, you would get the money from the buyer at the end of maturity period. Bank says, okay, but I'm not going to give you 1 lakh, I'll give you 90,000. Because the bank needs to make profit, right? Same way, zero coupon bond. So, the bank would actually buy the 1 lakh worth commercial bill at 90,000, discounted face value. Okay, the seller gets immediate 90,000 cash in hand. He is happy. He is not getting the whole money he needed, but he is getting most of it immediately. Okay, the bank would pay the seller 90k for a 1 lakh worth of commercial bill, and the buyer would pay the bank 1 lakh at the end of maturity period. Profit for the bank 10k. Clear? And with this, we have covered all of money market instruments. I hope it was clear to you. If you had any doubts or any confusions, please do ping it in the comments. Do like and subscribe if you like the videos. And we'll be back with even more videos on economics, geography, and if possible, even history. Thank you. Adios. Have a good day.